Hi there. Thanks for tuning in. Today we're going to be doing an analysis of Chase Corporation. Note that Chase Corporation is a specialty chemicals company. It's not the same as Chase Bank, which is part of JP Morgan Chase. So, without further ado, let's start analyzing. So, the overview of Chase Corporation is that they're a specialty chemicals company that operates around 5 countries. They mainly do adhesives, sealants, and additives, industrial tapes, and corrosion protection and waterproofing. And most of their cash flows come from North America, essentially. So here's the little glance that they give in their investor presentation. I'm pulling some slides from this presentation because I find them pretty informative. They have these three operating segments, as I was talking about, and these are these adhesives, sealants, and additives, industrial tapes, and corrosion protection and waterproofing. And essentially, a lot of industries are going to need all sorts of these things, especially to do with manufacturing and making new things. So they're going to work with a lot of partners over a lot of industries. And here is sort of this overview of who they're working with. For example, these industrial tapes go in the oil and gas sector, in the electronics, in consumer and packaging even. Pipeline coatings can go in water and oil and gas. And even the electronic and industrial coatings will go in electronics and even appliances or automobile spaces. So they are working with a lot of different industries, which gives them some diversification and gives them a little bit of protection. If one industry goes in a downturn, well, at least they have the rest. However, most of their market share is with these two, adhesive sealants and additives and industrial tapes. So it is important to note that regardless, they are going to be affected by overall downturns in the economy. If there's less manufacturing, they will probably have less clients that are willing to buy these products, right? And they are also going to benefit from certain trends, right? So essentially, trends in 5G, in electric vehicles, and IoT, and in renewable energy and grid expansion, well, they're going to need their sealants, they're going to need industrial tapes, they're going to need cable materials and whatnot. So Chase can stand to benefit from all of these growths. And they can stand to make a lot of new partnerships with corporations. They're actually a fairly small company. They have about a market cap of 1 billion, which means that they still have a lot of territory to cover in terms of what they can do. And their strategic priorities, what they're saying is that they want to have organic and inorganic growth. They want to have more operational infrastructure and commonalities, and they want to consolidate some assets. They want to adhere to financial discipline, which is cool. They want to focus on margin and free cash flow generation. I like hearing that they're focusing on free cash flow. I think some companies don't focus on that at all, and the fact that they're having that focus seems like, they have this focus on getting cash and reinvesting it or giving it back to the investors, and that's very important. And they also want to develop competitive advantages and further drive greater market share. Now, they are also a company that has acquired a few companies here and there. The acquisitions don't make a large part of the revenue, as we'll later see, but they have done both some acquisitions and some divestitures, and that's very interesting. So they're active in that, but they also seem to be running on very low debt for these acquisitions, which is good. We like to see that. So without further ado, let's look at some of the financial statements. You'll see that their revenue since 2020 has grown a whole lot, right? And so has their net income, or at least it stayed fairly stable. Their margins actually are great, 13%, 15%, 14%. These are pretty high margins for a company that has to manufacture things themselves. And it's pretty consistent here. So we like to see that. And generally, most of their revenue just goes away through basically the cost of production. And if they can make that more efficient, then a lot of the revenue can be turned to income, which is fantastic. Now, they also have a dividend, but I'm going to say you probably shouldn't buy this stock because of the dividend. Look at how, for a while, they paid an 80-cent dividend for a whole 4 years. Now they pay a dollar dividend for 2 consecutive years, and they have a dividend on an annual basis. So if you want to buy the stock for dividend growth, you may as well look elsewhere. However, this small dividend also keeps a lot of their cash not tied up, right? If the dividend were huge and they didn't have this cash to work with, then they couldn't do a lot of other strategic things. So the small dividend, sure, it's not going to give you a lot of direct returns, but it keeps them flexible, which may be better for them in the long term. They also have some incredible financial performance in some ways. The revenue has seen a little downturn until 2020 and then rebounded. I'm sure we can probably guess why, given the global situation. Same with EBITDA. Free cash flow has seen a little downturn lately. This is mainly due to changes in inventory. And so free cash flow could probably rebound from here. I cannot guarantee it, but I would not be surprised if free cash flow rebounds a little bit. And yeah, essentially, they want to return money to shareholders by supporting this annual dividend payout and essentially giving you all this growth, right? With all this liquidity, they can do acquisitions, they can increase the dividend, they can maybe do share buybacks, although they don't talk about it here, which is interesting, and they haven't done any share buybacks before. So with that said, they do actually have some plans to return money to shareholders, and regardless, you're going to participate in that growth. Now, I'm going to estimate free cash flow real quick. I'm using their free cash flow numbers from 2018 to 2022, and I'm going to compare it to net income, which I'm going to assume stays at 13% of revenue, right? And generally, free cash flow on average is about 120% of the net income, right? So I'm going to use the number. I'm going to roll with it for the future. Last year, they had a bit of a dip, right, where it was about 70% of net income. But for my predictions, I'm going to roll with this number because I wouldn't find it unlikely that they could rebound to even higher numbers than 120%. I'm just doing it to be conservative, right? And with that, I can do a discounted cash flow model for this company. And you'll see that there's a little rebound here. I'm going to give it a slight uptick, and then it's going to grow at a consistent 5% after that. I'm going to say the company's going to grow free cash flows and revenues at a very consistent 5% from 2024 to 2026. And then from there, it's going to have a perpetual growth rate of 2%. Now, if my required rate of return is 11% per year, my perpetual growth rate is 2%, then the fair value of Chase Corp would be $66.34. However, if we adjust for debt, then the fair value would be $54.12. And this debt is a fairly new thing. They didn't really run debt before, so I would expect this debt to evaporate fairly quickly within the next couple of years unless they really change their acquisition strategy. So maybe the value right now with debt included is $54.12, but in the future, maybe it could rise a little bit, but we're not accounting for that because we don't know what they plan to do with their debt exactly. Now, where's Chase right now? Well, Chase is worth $110.89 as of early May 2023. And you can see it has a market cap of roughly $1 billion, so it is a small cap company. And it's trading near all-time highs. So, or at least 52-week highs, that is. But you'll see here with this chart that Chase has some buying opportunities here and there, and also some selling opportunities. If you bought it in 2020, when the general stock market dipped, you may have done great. And if you bought it recently, in the middle of 2022, and it was also below this $80 point, and then you sold it right now at $110, you would have also done pretty good. Now, does this align with this model I have? No. And that may mean that I'm being fairly conservative as well. And that is something where I could maybe assign a higher growth rate for the free cash flow or for the revenue for Chase Corporation because they have had double-digit growth rates before. However, they also have some volatility, some cyclicality, and they are affected by economic downturns. So I cannot do that in good faith, knowing that it's better to just be conservative. However, this price is basically double of my fair value, right? So to me, this means that even though it looks like a solid company, this valuation just does not make sense for me. So is it well priced? Well, Chase does have a stellar record of stable profits and growth. We saw that their net profit margins were fantastic and were very steady. We saw that their revenue is generally growing. They have a focus on free cash flow, a focus on staying flexible, a little bit of a dividend. So it is a very consistent and quote-unquote boring company, which is kind of what you want as an investor, frankly. And it has plenty of room to take advantage of future trends. However, they're not doing share buybacks. If anything, they're issuing shares every so often. Shareholder returns hinge solely on growth, essentially. The dividend is basically negligible. That also means that we may risk paying way too much for growth. It's important to know that growth is great, but it really depends on what the future growth is going to look like. So at this growth rate of 5% in free cash flow and revenue over the years, Chase may not be worth it. If it's going to grow 10% or 20%, then I see that being incredibly worth it, right? But the likelihood of that happening is less than a 5% growth, especially if we're accounting for cyclicality just to sort of cover ourselves for any possible downturns in the coming years. So here's a discounted cash flow model with a lower return rate, right? With these same estimations that I've made, I would say if you want Chase at a fair value, if you bought it right now, you could expect more or less a 7% rate of return, which would give you a fair valuation of $108.49 with debt included, which is about where it is right now. So if you bought it right now, you would expect, instead of an 11% rate of return over the years, you would just get a 7%, right? If these assumptions prove correct. So if you were to buy Chase right now, with the growth rate that's assumed, you either have to expect a lower return, or you would be calculating for higher growth rates, which may be less likely. So that's the thing. So I must ask, by the end of this, how much is growth actually worth, right? And here's just an example of a great company that has basically all the boxes ticked except being well priced, right? So that is something that we have to take into account every so often. And maybe it's something where it's worth putting in our watch lists and just patiently waiting over the years, because as we've seen, Chase does have some downturns in the stock price here and there. It has a little bit of cyclicality. So you may just put it in your watch list, patiently wait until Chase is at a reasonable price, and then you take advantage of that opportunity, because that will come and go, and just as stocks go up and down every day. So growth is important, but there's such a thing as overpaying for it, and that's something to always be cautious of. With that said, I hope you greatly enjoyed this analysis. If you have any questions about it, feel free to comment down below. I'll be happy to read your insight into it. And with that said, have a fantastic rest of your day.